All right, how to calculate interest. And this is, like I said, this is a pretty important one because you need to know how to calculate it correctly in order to make the journal entries accurate. So first and foremost, we need to talk about the conceptual stuff. So in order to calculate the interest, it's the principal of the note, that's what you start with, times the annual interest rate. Typically, when you're given percentage rates on your problems and stuff, these are what we call APRs, or annual percentage rates. So they're based under the assumption of 12 months. Even if the note is not 12 months, they're going to give it to you in terms of 12 months. So that's where this last piece where it says times the time expressed in years, that's putting it in terms of a proportion of the year that you're actually going to be using this, or it's actually for. You'll understand what I mean by that when we do the examples here in a second. It is important, though, that if the days, if the time period of maturity date is given to you in days, so if it's like a 90-day note, it is important that you understand that a year for us, we assume, has 360 days. For the purpose of computing interest. That makes the fractions a whole lot more likable and not having to do any crazy decimals. So if it's 90 days, then we would assume it's 90 out of 360 rather than 90 out of 365. Again, it just makes the decimals a little bit easier to handle. So let's look. I'm going to give you 3 examples just of what you could see and how we calculate this. So first and foremost, the first one, a 1-year note for $50,000 with a 6% interest beginning March 1st. Okay, so first we're going to start with the principal. So again, principal times, or principal amount, times the interest rate, times the year in terms of year expressed in fraction of a year. Time expressed in fraction of a year. That's going to give me my interest, total interest. So let's put these numbers in there. What's my principal amount? We're at $50,000. What is my interest rate? We're at 6%. And what does this mean when it says time expressed in a fraction of a year? Well, this is a 1-year note, and this is going to seem really redundant to you. But if you get in the practice of doing it, it just makes things easier so you won't forget. This is a 1-year note or a 12-month note. Okay, so what I'm going to do is I'm going to put this 12 months over 12 months because it is over the course of a year. So that 6% that they gave us, it is under the assumption of a year, and this is a year. So that's why I put it 12 over 12. I know it looks weird right now, but just bear with me. Okay, and when I do this calculation, this is going to give me a total interest of $3,000. Okay, I know 12 over 12 is 1, but just again, if you put it in practice and keep it in a system, you're less likely to forget it. Okay, so let's look at another example. Okay, this one's a 9-month note for $50,000 with a 6% interest beginning on July 1st. Okay, we're at a 9-month now, not a 12-month. So let's go through this again. So again, your equation is principal amount times the interest rate times the time expressed in a fraction of a year. That gives you your income, or your total interest, excuse me. Principal amount still $50,000. Interest rate still 6%. But here's where it differs, okay? Because this is not a 12-month note, this is only a 9 months. So we're only going to be taking a portion of the 6%. So what we're going to do is we're going to divide it 9 over 12. That's why the last one I did 12 over 12, because it was a year. But this one we're going to do 9 over 12. We have to do that or we're going to be charging ourselves too much. And this is going to be, or we're going to be receiving too much. And that's going to give me a total interest of $22.50. I'm going to give you one more example of how to do this calculation. What happens if they give it to you in days? Just to kind of show you the other side. So what if it's a 90-day note for $50,000 at 6% interest on November 1st? So again, same thing. You still got your principal amount times your interest rate times your time expressed in a fraction of a year. It gives you your interest. Total interest. So again, principal amount is $50,000. Interest rate is 6%. But the time expressed in a fraction of a year, this time we're going to start with a numerator of 90, but we're going to divide it by that banker's rule of 360. And again, it makes the fraction a little bit more palpable. And by doing this calculation, it will give me a total interest of $750. So that's how you do just the calculations for the interest. In the next video, I'm going to show you how to do the entire example of interest or in notes receivables. So that'll give you a little bit more clarity. Appreciate it.